What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances. Welcome back, everyone, to another episode of the Long Game Podcast. I'm Jacob Turner. I'm here with my co-host, Thomas Kopelman, and today we're going to be talking politics. All right, I'm just kidding. We're not really going to be talking politics, but we are going to be talking about how politics and elections and cycles and things that we're heading towards here in the next couple of months should or should not affect money decisions that you potentially make in the future.
Yeah, I think, just for context for everybody listening, this is the Monday after Trump was shot in the ear, right? So this one actually was not a topic that we were thinking about talking about, but I think it does make sense because, just in this last week, I've had people ask me about it, right? One of my clients, we were delivering a financial plan to, 7-figure earner, tons of surplus, and he's holding a lot of cash in his business. And when I asked why, he was like, it just doesn't feel like a good time to invest, right? I'm expecting a lot of volatility, presidential elections cause a lot of volatility. And I think the goal of today's episode is to, really validate through data whether this is true or not. The one caveat, though, is if a president or somebody gets assassinated, that's different, right? Like if that might change how the markets react. Obviously, markets are still up. Things are going well right now, but very out of the ordinary things are going to cause short-term reactions. But what we're talking about here is not that. We're talking about regularity. We're talking about every 4 years, there's a new election. Every 4 or 8 years, there's a new president. And what does data tell us about that? And so, just diving right into it, I think, most people I had talked to assume, I'm curious to hear this from you, and honestly, what I assumed before I did research the last couple of years was that when Republicans are in office, the markets do well. And when Democrats are in office, the markets do poorly. I think that's what we all kind of grow up assuming because we associate lower taxes and more economic growth with Republicans. With Democrats, we think of higher taxes and more, dollars going towards uses in help for other people. But, whether that's true or not, at the end of the day, does that end up impacting markets? And so I think we have some really good graphics on this to really break it down. But Jacob, before I dive in the numbers, I'm sure you've seen this too, but what was your assumption?
I think for me, it goes back to something that I've just feel like I've had to learn over and over and over again in the course of investing, that time and time again, we think that market events, whether it's the election in this case or anything else that we can think of, is going to have some drastic effect on our investment portfolio, on how we should invest moving forward. It's going to quote unquote be different this time. And I think it's just another good reminder that oftentimes the market is forward looking and it's saying, it's pricing in what it thinks is going to happen. Now, look, there's going to be events that come up that nobody knows that they were going to come up. COVID is a great example in 2020. Like no market prognosticator knew that was going to happen. And you saw the volatility that ensued. And it's not to say that around an election time, there's not going to be more volatility because things are changing all the time. Like you just mentioned, Thomas, we're recording the week after Trump had an assassination attempt. Like nobody thought that was going to happen when he was speaking in Pennsylvania. And I think it's really important for people to understand, though, the market is a forward-looking entity. So if you look at some of the data recently, they're saying, hey, maybe this might have shifted Trump's odds of winning and made them a little bit higher. And with that, we've seen the market make some adjustments. There's certain segments of the market, particularly small cap value, that have been doing really well. And without getting too much into the weeds of why that may or may not be the case, I just think it's important for people to understand the data that we have, all the data, collective data, is going to be priced into the market, and the market's going to say, I'm predicting that I think this thing's going to happen. So for us to quote unquote win that game, we'd have to be able to predict ahead of the market with all the data that it has to say, hey, we think this is going to happen, and then be able to act on it faster than anybody else.
Yeah. And I think, the average person I talk to, there's like almost two groups of people I talk to. The index investor that thinks they don't really know anything different. And then there's the other people who think that they have this edge. And most times the edge they think they have is already priced in, right? You look back in COVID and all these people thought about like Peloton and Etsy and Shopify, like all these things like, oh my gosh, like everybody's going to be working out at home, Peloton, right? And then now you look at where Peloton is. And most times when people are making investment decisions, they're making it based on news headlines. And great investors already, know this stuff is coming, and it's already been priced into the market. The other thing I want to talk about here too is that we're talking long-term investor, right? We all have to remember that our goal here is to be a long-term investor and to try to get the best yearly returns over the longest period of time, right? If you get a great return and then you sit out of the market for 4 or 5 years, and then you get back in, you get a 15% return, you sit back out, like that is not going to put you farther ahead than somebody who's consistently getting solid returns. And so when news events happen, the markets do change in the short term, right? And so, going back to 2016, when it was looking like Trump was going to win, the futures markets dropped by 5%, right? 5%. Everybody's fearful, they're scared, they're like, what is happening? Nobody ever thought that he was going to win. But by the end of the market close on the next day, the market was up 1%. Right. And so I think people do need to understand that intra-year volatility happens, right? There is no way around it. Like, I think people will sit here and be like, oh my gosh, the S&P 500 is down 10%. Like, this is a black swan event. Everything's going to be going down. It's never going to really bounce back. But that is something that typically happens almost on a yearly basis. What we're really thinking about is long-term what happens. And so statistically, there's these charts, and, I'll link them in the show notes. But if you go back and look how it was per president, the markets are pretty much, from here going up and almost every single one. And the times that they didn't, right, you go back to pretty much the Great Depression, I think were the two only times on this chart where the market ended lower during that period of time. Because even if this one shows like 2000, when Bush was in, like it technically ended up from where he started. And then Obama's time, it, went up above what it was. And so if we look back on all of history right now, the average return with a 60-40 portfolio, which really means 60% stocks, 40% bonds, and this is the last 150 years, Republicans, 8.2% rate of return, and then Democrats, 8.4% rate of return. So pretty much equal, which I think, warrants people to understand that, like, I don't think it makes much of a difference who is the president.
Yeah, I think people want advisors or pundits to have some sort of vast opinion and say, well, based on if this is going to happen, here's what we're going to do. And I think that's oftentimes because we see talking heads on CNBC that they need to fill airtime. And good airtime is like telling people that, like, hey, if this happens, we need to make this move. And you see a lot of these analysts talk about it. And the reality is, let's play out the scenario. Let's play out the scenario. If anybody gets elected, Joe Biden gets elected, Donald Trump gets elected, doesn't matter. And there's volatility. And you time it perfectly. You get out of the market drops 5%. Well, now what? Because the reality is now you have to time it again when you get back in. And I think that's what people miss oftentimes. Like, to quote unquote be right in these situations, you have to be right twice. And what I see time and time again is, like, somebody might say, hey, there's going to be volatility. Volatility happens. They feel like they're right. But then a year happens and they've still not invested money. 2 years happens, still haven't invested the money. 5 years happens and they're saying, well, man, I wish I would have just invested, even if it was at the peak before that volatility started, before that election started. Because much to your point, Thomas, if you look at those election cycles and we magnify it and we say, okay, over a 4-year time period, how many times does that go down? Oftentimes it doesn't. And I think that's just the emotion behind investing. People want to know what the answer is going to be before they put their money in. And the reality is nobody knows. But what we do have is we have the data in front of us to say, if the data says this, part of our job as advisors is to be unemotional about that. I had a conversation with a client around this recently, and he said he had some additional money to invest, and he was like, what do you think we should do? And I said, my job is to give you the data on what we should do, okay? Make an unemotional decision about this money. Yep. This was about 6 months ago. We invested the money. The market's done really well. That's not because Jacob is smarter and Jacob knows what the market's going to do. That's just saying, I'm going to be as unemotional as I can and take all the data that we have and say, what is the best decision we can make with it?
and take your intuition out. I think a lot of times people lead investing decisions when you're investing globally based on intuition, when like it's really just a gut feeling. You have no idea, you're going to be wrong. I mean, just statistically, right? The market is up 70% of years. You're going to be wrong 70% of the time if you're sitting on the sidelines thinking, oh, this is a bad period of time. But the other thing that I do want to hit on here is just timing, right? So if we think about presidencies and how the markets go, a lot of it really actually isn't because of the president, right? If you think about, people look back and they're like, well, look at what Trump did, right? His markets were so much better. But if Trump was really in COVID for longer, right? Like Biden got in at a time that's like, well, there's a lot of uncertainty where the market's going. We're in the middle of this. We're still trying to figure it out. That's very different than having 4 years of the presidency without any dramatic events like that happening. But I think this is always where we go back to that chart that shows like the return of the S&P 500 over the last 100 years. And you see like every few years, there's this black swan event. There's something that is different than every other time, but the markets have prevailed. And so I think we should always go back to like, what's the goal of this money, right? If the goal is I'm going to buy a house in 2 or 3 years, there might be short-term volatility with what's coming, right? That's probably an area where I wouldn't say like, let's be in 100% equities for something that's going to be really short term. But if we look and say, this is retirement money I'm going to use 30 or 40 years from now, we probably shouldn't be making changes on short-term volatility for an asset that we're going to, not need for 30 or 40 years. And the perfect example of this, right, is like housing market crashes, right? Like you live in a house right now, it's worth $1 million. Housing market crashes 20%. Are you selling your house? And everybody would say no. And there's a few reasons. One of them is you live in it. So like that's fair. But another one is that people don't watch their housing prices like that, right? You take guesses. You're not making any decisions. In 20 or 30 years when you sell that house, in all likelihood, you assume that it'll be higher. There's no guarantee there. But that's really the perception and the mindset that we want people to have with investing is, what does this asset look like 30 years from now? And, I think that's where I bring people. They're like, hey, should I move out of the market? I'm saying, do you think the market's going to be higher 30 years from now or not? And they're like, higher. They're like, so then why are we trying to get out of it, right? What ends up happening is people, we're going down, we're going to sell at this low point. And then they're like, oh, it's going up. And they're like, well, I can't get back in. I'm going to wait for the next bounce. And then it keeps going up and then it keeps going up. And you end up buying back in and in a worse spot. Like that is what I've seen time and time again. It is extremely hard to make the right buy decision, sell decision, buy decision, sell decision on a yearly basis. Like you're just not going to get that right. And if you do get that right consistently, then maybe that should be your job. Like you probably would be one of the most successful investors in the world if that's what you could do.
Yeah. Oh, I think, and to go back to the numbers, I mean, statistically, it's nearly impossible to do that, especially as a quote retail investor. I mean, if you look at some of the biggest hedge funds in the world, they're underperforming some of the broadest indexes that are out there over long periods in time. So
Cathie Wood, right? We saw Cathie Wood this week. We're like, hey, if I only knew that NVIDIA was going to be higher, I wouldn't have sold it. It's like, okay, well, that is literally investing. That's how everybody feels. If we knew the price direction of any single asset at all times, it would make it really easy to make decisions, but we don't know. Nobody knows. The best investors in the world don't know either. Most times what they're best at is having the right position to be able to hold assets for the longest period of time.
Well, we talk a lot about what things don't change, right? If somebody comes to me and they say, when's the best time to invest? I'm almost always going to say the same thing. When you have the money and be able to invest it, right? Like it's that old analogy about the tree being planted. The best time to plant it was yesterday. I think the other thing that doesn't change is just our own human emotion with it. There's never been a time over the past 15 years where I've been like, man, this is a great time to invest. I can't wait to invest. The only time I actually felt like that was in the middle of COVID. And I was like, man, I wish I had more money to be able to invest, because I just had the conviction that like at some point this is going to come back. Now, granted, that was also really scary. And it's not to say that we were expecting, the V-shaped recovery that we got. But I think it goes back to like the things that don't change, they don't change for us too as investors emotionally. Like, it's just going back and always trusting the data and trying to make as unemotional decisions as we possibly can. And it all goes back to the thing that we talk about a lot, Thomas, like what is the end goal? If the end goal is to outperform the market the next year, okay, maybe you want to take your chances with it. It's not what I would do, but if the end goal is that you want to try to build wealth to reach all the goals you have in the future, and it might sound cliche, probably the best time to invest is today.
And I love that you said that, because that goes back to the DCA, dollar cost average versus get money into the market. And so I wanted to pull up, Nick Maggiulli's study on it. And there's a few points that I do want to make. And so he basically looked at all the money in versus DCA over 2 years and what the difference is. And DCAing underperformed, looking backwards on the last 25 years, DCA loses 81% of the time, and by 10% on average at the end of its 24-month buying window. And again, we go back, right? If markets are up 70% of the time, this just makes sense. And so a lot of times when people think about DCAing, they're actually lump sum investing, right? You investing every month what your surplus added dollars are is you investing every dollar that you have, right? You're not choosing to DCA. DCAing would be, I got a $100,000 bonus. I'm going to spread that out over the next 12 months. And statistically, it shows that that's not the better move. Sometimes it is for the right person, because if you put that in and the markets drop by 20% and you're going to sell out and be fearful forever, do it over a year and, get more of an average there. But the line that he put here, he had a whole paragraph or a whole section on this that was like, okay, let's imagine you get $1 million and your choice is to put it all in today or DCA over 100 years. What would that look like? And he goes, I'm not even really going to talk about the statistics on it, because everybody here is saying, well, why would I wait 100 years? And he said, if you're not going to wait 100 years, why would you wait 100 months? Why would you wait 100 weeks? Why would you wait 100 days? Like, at the end of it, what is that right time frame? Statistically, it shows that it's not better. The only time it makes sense is behaviorally, if that's the way that you can continue to invest.
Yeah, I think you make a great point there. Like, if you are going to be in a situation where if you put your money in today, no matter what the situation is, and if something happens, you're going to pull it out right away, I think dollar cost averaging can make a ton of sense, because it's better to dip your toe in the water if that's what it takes to just get in the pool. But at the same time, oftentimes it makes more sense to actually just jump in the pool. But the reality is, we both know that the emotions with investors play tricks on them, and we want to make sure that somebody's invested for the long term. Because the thing that I tell clients is the same thing I want everybody to hear is, like, if we stick with the strategy over a long period of time, we will win. The way that we don't win is we pick a strategy, and then in 2 years, we say, oh, we want to pick another strategy, and then we want to pick another strategy, and we want to pick another strategy. That might sound smart. That might sound cool. That might be a great campfire story. That does not work with investing in the public markets.
Yeah. Totally agree. I mean, I don't think there's too much to hit on here other than just kind of recapping the fact that, remember that all of these investment decisions really do start with understanding, what are the dollars I have? What is the use case? What is the goal? What is the time frame? Aligning investing with that is most important. And then just honestly dropping your ego and understanding that you do not have an individual investment edge here. The amount of money that Wall Street puts into algorithms and the best performing investment managers, et cetera, you with a full-time job who spends an hour a month trying to guess on investments, is you're not going to beat it. And so now, as we think through the presidential elections, we don't know. I think a good financial advisor will admit we have no idea where the markets are going to go. But at the end of the day, we can look backwards at research and understand, hey, average president, between them is like 8.3%. One was 8.4, one was 8.2. There'll probably be a little volatility as this starts and who's going to win and what is that going to look like. But from there, we have research to see that here's what returns look like. It doesn't really matter by the person, and that if you have long-term money, invest according to your long-term goals.
Yeah, 100%. Well, I think that's a great bow on what we've been talking about. And again, when we think about the election, nobody knows what's going to happen. But the reality is, just remember, the market has a lot of this data that's going to be priced in. And if you're going to try to time the market, you have to be right twice. So we appreciate you guys listening. As always, Thomas and I are always looking for great topics. So if you have topic ideas that you think would be really interesting for us to discuss, or potential guests that you think would be great personal finance guests to come on, please shoot us a DM on Twitter or send us a message on LinkedIn. As always, we'd love it if you guys would like, rate, and subscribe to the podcast. I know we have this on YouTube as well, so if you like video format, check out Thomas's YouTube as well. Till next time, guys.